How does insurance work? Answer: Insurance works by sharing losses among a group. Summary: Insurance distributes financial losses among many people. What is risk? Answer: Risk is the possibility of deviation from expected outcome. Summary: Actual results may differ from expectations. Which risk is generally covered by insurance? Answer: Pure risk. Summary: Insurance mainly covers loss-only risks. What are pure risks? Answer: Risks resulting only in loss or no loss. Summary: Pure risks never involve profit. What are the possible outcomes of pure risk? Answer: Loss or no loss. Summary: Pure risk does not include gain. What are speculative risks? Answer: Risks that may result in gain, loss, or no loss. Summary: Speculative risks involve both profit and loss possibilities. What are the possible outcomes of speculative risk? Answer: Gain, loss, or no loss. Summary: Speculative risks can produce multiple outcomes. When does speculative risk occur? Answer: When there is a chance of gain or loss. Summary: Speculative risk involves uncertainty with profit opportunities. What are the possible outcomes of pure risk? Answer: Loss or no loss. Summary: Pure risk never results in profit. Why are speculative risks not insured? Answer: Because they are voluntary in nature. Summary: Speculative risks are intentional and profit-oriented. Why would insuring speculative risks create problems? Answer: It encourages risky behavior. Summary: Insurance coverage may promote careless risk-taking. Question: What is insurance in risk management? Answer: Insurance is a system of sharing financial losses among many people. Summary: Insurance spreads risk among members. Question: What is risk mitigation in risk management? Answer: Risk mitigation means reducing the frequency and severity of losses. Summary: Risk mitigation minimizes both the chances and impact of losses. Question: What are the two key elements of risk mitigation? Answer: The two key elements are prevention and reduction methods. Summary: Risk mitigation works through prevention and reduction methods. Question: How does prevention work in risk mitigation? Answer: Prevention reduces the frequency of losses. Summary: Prevention aims to stop accidents before they happen. Question: How does reduction work in risk mitigation? Answer: Reduction decreases the impact of losses. Summary: Reduction minimizes damage when a loss occurs. Question: What is an example of prevention? Answer: Wearing helmets is an example of prevention. Summary: Helmets help reduce the occurrence of injuries. Question: What is an example of reduction? Answer: Fire extinguishers are an example of reduction. Summary: Fire extinguishers help control damage after a fire starts. Question: When is prevention most useful? Answer: Prevention is most useful before risk materializes. Summary: Prevention works before accidents occur. Question: When is reduction applied? Answer: Reduction is applied when a loss occurs or is about to occur. Summary: Reduction controls damage during or after an event. Question: What is risk transfer in risk management? Answer: Risk transfer means shifting risk to another party. Summary: Risk transfer passes financial burden to another entity. Question: How does insurance transfer risk? Answer: Insurance transfers risk by compensating losses when they occur. Summary: Insurers bear financial losses on behalf of policyholders. Question: What is risk retention in risk management? Answer. Risk retention means accepting and bearing risk internally. Summary. Enterprises keep and manage certain risks themselves. Question. How are risks finally treated in risk management? Answer. Risks are treated through mitigation, transfer, retention, or a combination of methods. Summary. Effective risk management uses multiple treatment methods together. What is the key difference between informal and formal risk sharing? Answer. Formal risk sharing is organized and reliable. Summary. Insurance provides dependable financial protection. What is the main advantage of insurance over informal help? Answer. Insurance guarantees compensation for covered losses. Summary. Insurance ensures financial security after loss. What is meant by insured peril? Answer. Insured peril is a specific risk covered under the policy. Summary. Only listed risks are covered in insurance. What is meant by indemnity in insurance? Answer. Indemnity means restoring the insured's financial position after loss. Summary. Insurance compensates actual financial loss only. Which principle ensures no profit from insurance? The principle of indemnity prevents profit from loss. Insurance restores loss, but does not create gain. Question. What is the main focus of risk management? Answer. Risk management focuses on handling all types of risks. Summary. It manages both pure and speculative risks. Question. What is the difference between insurance and risk management? Answer. Insurance handles pure risks, while risk management covers all risks. Summary. Risk management is broader than insurance. Question. How does a risk manager handle speculative risks? Answer. A risk manager reduces uncertainty and controls volatility. Summary. Speculative risks are managed, not insured. Question. Where are identified risks recorded? Answer. Identified risks are recorded in a risk register. Summary. A risk register documents all risks. Question. What is risk evaluation? Answer. Risk evaluation measures risks according to possible loss impact. Summary. It assesses the seriousness of risks. Question. What are the two dimensions of risk evaluation? Answer. Risks are evaluated using frequency and severity. Summary. Frequency and severity determine risk impact. Question. How is risk gravity estimated? Answer. Risk gravity is estimated by multiplying frequency and severity. Summary. Frequency times severity estimates economic impact. Question. What does frequency measure? Answer. Frequency measures how often a loss occurs. Summary. It shows occurrence rate of loss. Question. What does severity represent? Answer. Severity represents the average size of loss. Summary. It measures financial impact. Question. How does risk evaluation support decisions? It ranks risks based on their impact. Summary. Important risks are treated first. Question. How are risks classified after evaluation? Answer. Risks are classified according to gravity of loss. Summary. Serious risks receive higher priority. Question. What is risk avoidance? Answer. Risk avoidance means completely eliminating exposure to risk. Summary. The risky activity is not undertaken. Question. When is risk avoidance most suitable? Answer. It is suitable when risk probability and severity are very high. Summary. High-risk situations are often avoided. Question. When should an enterprise undertake a risk? Answer. A risk should be undertaken when reward justifies the risk level. Summary. Benefits should outweigh possible losses. Question. Why is risk-reward trade-off important? It helps make balanced and informed decisions. Summary: decisions should balance gain and risk. How does insurance limit coverage? Answer: insurance covers only insured perils. Summary: only specified risks are compensated. How can multiple causes of loss affect insurance claims? Answer: only insured causes of loss are compensated. Summary: claims are payable only for covered risks. How can insurers pay claims higher than individual premiums? Answer: insurers use pooled premiums collected from many policyholders. Summary: risk sharing allows payment of large claims. Question: when should insurers adjust probability models? Answer: when risks or trends change. Summary: models must adapt to changing conditions. Question: who is most affected by incorrect future estimates? Answer: insurers' financial stability. Summary: wrong estimates can harm solvency and profits.